something that we'll be discussing.
Yes, we are. In fact, you guys spoke about stocks, and the sector which is doing extremely well right now is the FMCG pack. HUL has moved to the high point of trade. Britannia has moved to the high point of trade. And the other one which is doing extremely well is ITC, up about 1.5%. That's primarily on account of the announcement that they made yesterday. Will pick up an initial 39% stake in Yoga Bar owner Sprout Life Foods for about 175 crores, and they will hike it to 47.5% by 2025, and in the next 3-4 years by the entire company itself. Now, to discuss this, we have with us Suhasini Sampath, who's the CEO at Yoga Bar, joining in to discuss this deal. Thanks a lot, Suhasini, for joining in. First up, congratulations on this deal itself. Just a couple of numbers before we start. You are doing an annual run rate of almost 100 crores in terms of sales. Typically, food companies work in gross margins of anywhere between 30 to 40%. So what are the gross margins that you function at? Secondly, are you profit making on an EBITDA level? And thirdly, what exactly is your online-offline mix?
Thanks, Mangalam, for having me over at this, to speak with you. The first question, of course, our gross margins are higher than what you mentioned because we, deal with products which are higher gross margins, primarily breakfast, and we also, sell bars, which are also pretty high gross margin. From the perspective, we're super excited about this deal. I think, expanding our distribution reach from 6,000 to using ITC's, really strong distribution strength is something that's super exciting for us. Can you repeat the two other questions that you asked me?
One was, whether you were EBITDA profit making, and you said gross margins were higher than the range that I mentioned. What exactly is the range? I mean, if you could give us, is it 40 to 50, 50 plus? And
it's in the 40 to 50 range. Which is higher than most other, food companies because you obviously trade in sort of, high margin products. We are not EBITDA positive at this point in time, and that's because as we think there is tremendous scale to kind of invest in. We are definitely CM2 profitable, which means that net of marketing, we're obviously profitable. But of course, we're using a lot of that to kind of grow market share. We're a very market share focused company in all the channels where we are present. And we're obviously investing in kind of, building out the team, building out the support system, kind of using new age marketing to, really expand out category share. That's something that we're heavily investing on. But a very healthy kind of, in the startup system, we are known to be extremely careful with the way we spend money.
Okay, congratulations, Suhasini, firstly, on what would be a momentous day for you and, a momentous deal as well for the entire startup community. But I just wanted to ask you about this additional 47.5% stake, which you all will be eventually selling to ITC. What is it contingent on?
Any exit construct is obviously a combination of both your revenue and your EBITDA. And while I can't kind of divulge the exact, valuation, I would say that it is a deal as founders, we feel is completely fair. As ITC feels, has done their best in terms of giving us, a very, very fair construct. And of course, there are plans to build out the company really large and multiples are based on how large we can actually take it.
Okay. So when you're talking about you are looking at building the company and growing as well, what is it that ITC can bring for you? The scalability that you're looking at, it is 45,000 crore market opportunity, but it's very crowded as well. So apart from cash and expertise, what is the other contribution and growth that you're looking at here?
So obviously Yoga Bar is uniquely positioned in being like the first health food brand in the country, right? You've had so many occasions where people would go to buy a health bar in a shop and would say, give me a yoga bar, irrespective of the brand that they wanted to buy. I think first movers who use clean ingredients, who kind of focus on health. I mean, Anandita and me have been at it earlier than, at a time when people used to say tasty bikta hai in, India mein. We were like literally the first ones. And everyone has seen the advantages of being the first mover, like Flipkart, like Oyo, like all of that, right? So obviously there is, the tremendous brand equity of having been the first mover. So while we think that the market is crowded, I think Yoga Bar has carved a very, very early mover advantage space. And from that perspective, the brand is really strong. And because we as entrepreneurs are so passionate about building products exactly like the way we feed our families, I think our consumers have resonated with us. We only produce those products that we feed our own children or our own parents and things like that. And consumers have ended up really, being a champion of this product. Like today, I received more messages congratulating me from all the consumers who've kind of like been part of Yoga Bar's journey. And I think that for us signifies that while we do see
Right.
competition,
Yeah,
we're not
get that.
afraid of it. And with
You know, Suhasini, we get that point that you obviously are first movers, etc. But that's also one of the risks, right? Because companies which are first movers usually get disrupted by people who've gotten in later with less legacy costs and less trial and error. We'll talk about that in just a bit. But with regards to the scalability that ITC can provide, you said you're available in 6,000 stores. ITC is available in more than 4 million stores. Just wanted to understand, what is the scale that we're talking about here? I mean, if we were to look arithmetically, the sales could grow up by almost 50 times, but that's unrealistic. On a realistic basis, what's the scalability for revenue for you guys? And you said X of marketing spends, you are EBITDA positive. What as a proportion of your sales are marketing spends right now? What do you think it will normalize at once it scales?
Sure. I think so. With ITC's kind of support, we are going to get like a very, very large distribution. But along with that, we're also going to get logistics support, supply chain support, sourcing support, etc., to further improve your margins and things like that. But the point being, of course, in FMCG, you can't do the math like that, because as you incrementally increase your stores, the throughput per store, declines as you go beyond the first 50,000 and the next 50,000, etc. But from a perspective of being a 100 crore brand in 5,000 stores, you can sort of like imagine that 5,000 stores is actually a very, very small representative of the number of stores where Yoga Bar can actually sell. So from that perspective, the potential is very, very high. Because and you asked me this question earlier, how much of your sales is online and offline? We have 50% of our sale coming online, right? And in large platforms like the Amazons and Flipkarts of the world, we are the #1 selling breakfast brand. So from that perspective, if we had to repeat some of that success offline, you can well imagine how large this company can actually be.
Okay. So Hasni, just a two-part question. One, this additional 80 odd crores, you're not, divulging what those milestones or those contingencies would be. But is there a chance that it could be revised lower if in case those milestones are not met? One. And two, you're tracking, you did around, correct me if I'm wrong, sales of around 68 odd crores in FY22. What are you tracking in FY23? What are you possibly envisaging or internally targeting in FY24?
Yeah, we are a 100 crore plus brand in the current year, right?
Okay.
From the perspective of the 80 crores, it's not contingent consideration. It's consideration that's committed. I actually think, and I'm hoping that, given our growth and given the kind of category share that we'll take across multiple categories, maybe we'll be back on the table kind of having, people wanting to invest even more, kind of grow even faster. Obviously, that's the scenario and that's the entrepreneur mindset with which we go into anything, right? You always expect things to do much, much better than even what we put on paper. So we're actually expecting that maybe ITC would want to invest more and grow even quicker and even faster.
So Suhasini, just last question before we let you go, because you're talking about the growth prospects, how you are very optimistic on the brand and the business as well. What made you sell at this point in time, and what does it speak about the D2C world? Because while you were an early mover, there were no funding issues, so to say, but now it has dried up. So what does it speak about the D2C brand and your brand as a whole?
Yeah, so ours is a mix of both, like, raising capital as well, right? Because ITC is committed to the 150 crore consideration for us to really grow the brand. I think entrepreneurs look at, exits to see the kind of legacy that they can leave behind. I take deep satisfaction, both Anindita and me take deep satisfaction in the fact that now this brand is going to live for another 150, 200 years or how many ever years, right? And we're going to be feeding India really healthy food. And eventually with, ITC support, we could take this brand global as well. And some of those aspirations for us is far larger than our own personal goals. It's how big can Yoga Bar be? And with an engine like ITC, we see that, anything is possible. It could disrupt healthy food as we know it in India. It could disrupt healthy food as we know it in Southeast Asia. It could disrupt healthy food as we know it everywhere. So we're really excited about that prospect.
Suhasini, thank you so much for joining in, giving us the details of the deals as much as you could. And we would have liked to speak to you about your plans after Yoga Bar as well, but that for another day. For now, the street